Afternoon, folks. Market review for Thursday, July 13, 2017. First and foremost, I'd like to apologize. My laptop that I have with me, they did a Windows update this morning that took forever. It was like 47 minutes before the whole thing was completed. And I couldn't communicate by way of the forum because I only use this laptop, and the other one my son has with him in New Orleans. And because he's away, he's technically off. So I guess he slept in. But nonetheless, I wasn't able to get in on time this morning. So I'm going to be doing the session discussion at the end of this presentation. All right, so the dollar index, we've had, again, a rather lackluster day. Nothing really happening that's terribly exciting. The low on the daily here, we had 95.43, and today's low came in at 95.45, so just 2 pips above that. So it still failed to get down below or even touch the old low on the daily. Now, tomorrow that might change. I mean, we could see a move below it, but I just don't believe there's going to be a move below it and then have that whole expansion down to 94.75. Not that I'd like to see it happen, or not that I have to have it happen again in one single day, but it can. But I don't see it going into the weekend with a Friday. So it may not even get down there, to be quite honest with you. We could be failing to go lower here, and it may shoot up here and get to this level here. Even though I'm looking for a sell-off from this price point, the longer it stays down here like this, the less inclined I want to sell up here. I would have liked to have seen it try to get up here by now, really, try to make an attempt, but it hasn't done so. So I mentioned before how we could probably just stay sideways and consolidate in here. And unfortunately, that's what we're seeing. And it's very frustrating because we want to see movement. But it's the dog days of summer, so it is what it is. Euro, pound, nice move off of the 89.35 level we were looking at. Rejection there. The 74 level here, 88.74, we're looking for a failure of this level at 88.80. If that level gave up, you're looking for the fair value gap to close in here and maybe find some support. It didn't. It offered resistance right there. Look at the high, 88.74, and the candle's high here, 88.74. Beautiful, beautiful price action. Euro dollar, we saw price come up. This wick in here admittedly threw me off. I didn't expect it to be returned back to this candle here. Yeah, we have mitigation over here, but this wick, when I was looking at Euro this morning, I was contemplating giving something for this pair over the cable. And I'm glad I didn't, but nonetheless, I was a little surprised by this price action in here. The price did come down, knock out the equal lows, sell stops in here, and so far we're just treading water, sideways. So do we see continuation down into this low here? I don't know. To be honest, I don't know. I'm having a really hard time getting a read on where we're at technically. So while it looks nice as a potential deeper intermediate term retracement likely to unfold here, we can come down, take out the short-term low, and maybe revisit these old highs back here, and that would facilitate a stop run on trailed stop losses. I don't know. I really don't have a good read on it, so it's kind of messy, and I wish I had more to say about it, but I don't. So moving on to cable, I gave you something to work with last night. If we saw 29.30 give way on the downside and start to rally back up, we could take a short at 129.27 on a limit. That means at 129.27 or higher, if you can go short there. That was my suggestion for a demo trade. Well, initially it showed a willingness to want to go lower, but then came all the way back up during the New York session just to go above the high where the stop loss was, hit it perfectly right to the pip, and then went down. Took out the short-term low, and now we're back in the middle again. So we have a Z day here, just like we're seeing for the dollar index. Nothing terribly exciting. Very hard unless you're a scalper and you're fading highs and lows, which I didn't see that going in. So I know some of you are going to probably be cynical and say, well, why didn't you do that, Michael? Well, I didn't believe that was going to happen. I felt that we were going to come down, take the sell stops below here, and maybe clean this area up here as well. And that's why you saw the order here to take that short off, but it didn't get down there. So nonetheless, stopped out 24 pips there. So not a big deal, but nonetheless, it was a little frustrating. There's two other pairs I want to talk about real quick, just in summary. Aussie dollar. I gave you guys this scenario for Aussie a couple days ago. Okay, I told you this high here. I told you we were coming down here. We hit these old highs. That'd be a nice area to be a buyer. Apart from that, I wouldn't be interested in anything else, and it turned out to be a very nice little move. Traded up to 77.30. We are looking for 77.20, 77.30, and it went as high as the high come in at 77.40. So not bad of a price move. I don't think we're done with it. I think we'll go a little bit higher. If you go to again, using a weekly chart, as I discussed this week, we have these old highs back here, equal highs here as well. So we have a little bit of a move left in the gas tank, if you will. I think we'll go higher, and we'll reconsider this bearish order block here at 78.75. We'll call it 78.80, 78.80. 78.75 to 78.80. I think that's a next upside for short term. So about 150 pips or so from where we're at. I don't think that would be it either. I think we're going to try to drive up into clear up some of this area over here. Very nice. All this big price action, smack dab in the middle of it, and I'll measure that with a fib. You guys can get a feel for that for equilibrium purposes. So what I'm measuring here is the range. Actually, that's on the wrong spot, Michael. Right there. All these down closed candles. Right in the middle of the range is that equilibrium price point right there. Boom. And it would close the gap also. So draw that out in time. We would have this as a swing objective for those that want to trade Aussie dollar and use your tools for a little bit longer term setup. This could be a position trade. Could be a long term position where you get something on down here and don't worry about the minor fluctuations each day. Just take it and hold on to it and see if you get these big runs up into 84.20. The other one I had discussed was the dollar CAD, and while we were looking for a couple different scenarios, this thing has really fallen out of bed, and now we're just consolidating. So everyone that's been trying to catch up and do something with it since the move on yesterday, they're getting chopped up just as well, like we were on the cable. So we're probably not going to see very much in way of volatility tomorrow. We'll probably go into a really soft session as well. So tomorrow we're going to be doing a New York session, Lord willing. I'm not going to be allowing any Windows stuff in the future. I thought it would be a quick Windows update, but it turned out it was like a monster. It just kept going on and on and kept restarting my laptop and kept restarting and doing all these different things. So the 2016 mega trades will be reviewed tomorrow. So that's going to be like the focus of the session. We're not going to really be trying to do too much of trading tomorrow. I'll give you my view about what I think may unfold for this the New York session. For those that really don't want to spend too much time looking at the mega trade stuff, they want to look at the live sessions. I will do that real quick in the morning, at the beginning at 8:15. By 8:30, we'll start the discussion about what took place in 2016 and how that's useful for you in your learning. And then we'll close the session at the end of the week, and then you'll have your second lesson for this month's delivery Saturday night at 9 p.m. So with that, I'm going to close this one. We will go into the 2017 first half of the year, what mega trades took place for this year. All right, folks, we're going to take a look at the 2017 first half of the year, what mega trades took place, and how we can use that as a learning tool. Okay, the first one we're going to look at is the soybean market, and this is part of the grain complex, so the grain sector of commodities. What we're looking for is the dollar index. When the dollar index usually goes higher, commodities will go lower as a result, and when the dollar index goes lower, commodities will go higher. So we're seeing the bearish moves in the dollar index since the beginning of the year. Each decline should brought with it a new rally in commodities. Now, if there's a deflationary period, there's going to be times when that occurs, and we were obviously been in the deflationary period. Commodities can move in the same direction with the dollar index because everything's going to be dropping down. That's what we end up getting. It's the times when we don't have deflationary periods and we have inflationary periods, we can see dollar index and commodities be diametrically opposed, very, very sharply diametrically opposed. So when we have the deflationary period like we've been now, all the commodities have been dropping as a whole. Lower prices are expected, and therefore it's moving in tandem with the dollar index. So in your notes, when we have this deflationary period and commodity prices are dropping and the dollar index is dropping as well, you can time the shorts for commodity trading in your paper trades with the sell-offs in the dollar. When the dollar index is making its highs and selling off, we can time a lot of the commodity short selling for your paper trades with the sells that take place in the dollar index. So if we're looking for markets that are diametrically opposed to the trend direction of the dollar index, we're going to be looking for markets that create conditions that are bullish. So if dollar's going lower, we're going to be looking for trends, okay, or sectors or commodity specific that are failing to follow suit with the down move in the dollar index. And that will give us our buy scenarios. So the first one we're looking at here is soybeans. And it wasn't until the sell-off that took place the third week of June for the dollar index, it sold off. And that same third week of June saw the soybean market rally up. Notice also during that consolidation in the month of June for soybeans, the open interest, it's a little bit hard to see it, but the open interest declined rather aggressively, and we saw the soybean market rally up a full dollar, which is $5,000 per contract of a move, if one were long. So we had a really nice pop in the soybean market during a seasonal time when the grain markets usually have some measure of a rally. So we see that timed with that sell-off in the dollar index in June. Okay, the next one we're looking at is corn as a grain complex. Corn's been in a consolidation for a while, so while there may be a future move with a great deal of magnitude at a later time, right now there hasn't been really any indication that corn is trying to do anything at the moment. So corn has been a underperformer, and it's been an underperformer for a while. As a whole, commodities have been an underperformer as an asset class, but using the tools that I teach in terms of finding relative strength between the sectors and looking at the individual markets, we can ferret out really nice moves that would go against what the dollar index is suggesting. So corn was a dead market. Diller didn't have anything there. Wheat is one that I liked because we were failing to go lower, and at a time when seasonal impacts come in for wheat to go higher. Wheat is a really good, strong market to watch in the summer months for seasonal low. And if there's anything going on with the crop, if there's any concerns about the crop not being good, man, this market can really go up like soybeans. It can be like a rocket. And we saw early signs of accumulation as the dollar index was going lower in the month of May. Dollar index sold off rather aggressively. At the same time, the wheat market failed to go lower. It wasn't going lower at all. It was actually making a higher low. And that's what you're really looking for. You're looking for some measure of accumulation to come in. And while soybeans were moving lower, and we showed this in previous examples, wheat was actually showing the relative strength against soybeans. So there was a lot more buying taking place in the wheat market early on because of some fundamental supply and demand factor that I'm not aware of, but I can see it in the price action. And wheat was under accumulation, and ultimately it moved over $1 as well. And it's a $5,000 move for this commodity. So far, corn has been a non-event. We didn't have any evidence that was going to go higher. Soybeans and wheat were really strong. Wheat being the better buy because it had a higher low. Now, soybeans traded down into a higher time frame order block, which caused its point of accumulation. Wheat was showing overall relative strength against the soybean market. So as a whole, the grain complex or the grain markets, the leadership issue was wheat over soybean, but soybean was not a bad buy either. Corn was a no trade. So we would be buying the wheat market as a example here and potentially seeing sympathy play with soybeans going up. Anytime the grains go up, soybeans kind of like try to muscle in, become the leader. It's a really big market for grains. It's like the S&P for grains. If you're looking at indices, they all want to be in that one. So if there's any kind of spook or concern about the grains, they will be looking to dogpile in on soybeans. But the clue came in by way of the wheat market diverging. And look at the massive decline in open interest at that time, going in from the last week of April into May. Huge reduction in open interest. So commercials were heavily covering on their short selling. So if they're not willing to hold short, they are expecting higher prices. And they came in short order, really quick, rallied up hard, aggressive. Okay, soybean meal, same scenario, similar to what we saw in the soybean market. Soybean meal is a derivative of the bean, and nothing really strong here. I'm only including it as a way of using it for completeness sake, and I'll show you this isn't that big of a deal when we look at the soybean meal or soybean oil market. Only if those individual markets go into a premium, and many times if that's going to be true, we will see the soybean market itself go into a premium. That means the nearby contracts are selling for more money now than the distant months out, and that implies a great deal of demand, and otherwise there wouldn't be a higher price right now. There'd be higher prices in the future. So the soybean meal, they're just not really markets that I'm concerned about anymore. Early on as a commodity trader, I believed that soybean meal was an animal entirely of its own and had capabilities of doing completely something opposite to what soybeans themselves would do. And that was a misunderstanding on my part as a new trader. So it goes without saying that if soybean meal is going to go up or if it's bullish, soybeans themselves should be bullish, and therefore the other derivative of soybean oil, would be also bullish as well. So we don't care too much about those commodities, but I mentioned them here just for completeness sake. The next market we're looking at is the meats, and this is the meat sector. And we're looking at the live cattle market versus the dollar index. And you see all through the beginning of the year, dollar index has been dropping. And in February, we saw the cattle market show an unwillingness to go lower, and it was accumulating. Wouldn't go any lower, wouldn't go any higher. But during that consolidation, notice what was happening in open interest. Open interest was declining, which is indicative of commercial short selling. At the same time this was occurring, there was a premium in the nearby months to the distant months out. So in other words, the February cattle delivery month was selling for more than the August delivery month. And that only occurs if there's real supply and demand factors in the market, implying that there's going to be a short supply and a heavy demand for cattle. So everybody wants to have their cheeseburgers and steaks, if you will, and they're going to be seeing higher prices, or the commercials are expecting higher prices, let's say it like that. And they're usually right. They're not always right to the day, but they can afford it because they have deep pockets. But cattle prices were indicating a higher trend is in order. There was a premium there, and cattle themselves had a reduction in open interest. So all the telltale signs we look for, we saw the market create a high in March on the dollar index and sold off. So in March, we could reasonably expect to see the cattle market to rally, and it does that very thing here. After the reduction in open interest, the market was free to rally up from 102 all the way up to 126. So that's 24 times 400. So really big moves were seen here in the live cattle market. So we've seen wheat, we've seen soybean, and so far live cattle. Next market is feeder cattle, and it's very similar to what we saw in the live cattle market. The only difference here is this is a processed cow. Live cattle is what it is. It's got a heartbeat still. This is one step before you get your steak on the plate. The feeder cattle market was very similar. We saw a reduction in open interest ahead of the February month, and we saw another reduction in open interest in the last week of February going into the middle of March. And feeder cattle can be a little bit thinner than that of the live cattle market sometimes, but you have to look at the open interest declines on both live and feeder to get a really good, clear depiction. Many times, if you're seeing a big reduction in open interest on live or feeder, that's useful because they're closely correlated. You're never going to really see like feeder cattle going volleying straight up, limit up, and then feeder cattle going down. They're going to be pretty much moving the same direction. But this commodity as well, moving from 124 all the way up to 160. Each one of those full handles is $500 per handle. So that's about $18,000 per contract for anyone that was long from the 124 price level back in March. So we've had soybeans, wheat, the cattle markets, both live and feeder. They have met the criteria for mega trades. And in lean hogs, came in right at the seasonal time period for it to rally. If you look at your seasonal tendencies, this is a move that usually comes in every year, not to this degree or magnitude, but there's usually some measure of buying that takes place in the hog market around April-May time period. And you can see that the lean hogs market here traded down to 70 cents. And if you look at historical prices for hogs, that's a really good price level by itself. So if you want to speak in terms of support and resistance as a fundamental basis, 70 is a really good level historically for hogs, just like 30 cents and 40 cents is. If you ever see those price levels in hogs, they're just amazing buys. But this commodity also, like the feeder cattle and live cattle markets, this was also at a premium. So the nearby months were selling at a higher price than the distant months out. At the same time, when the dollar index was selling off in April, the market created a low in lean hogs during the seasonal time period when there was a premium, and price went straight vertical, and it's still going higher, and it's been going higher for a while. Each one full handle from, for instance, 71 to 72, and that's $400 per handle per contract. Very, very nice move. So we've had, in the first half of the year, we had lean hogs, live and feeder cattle, soybeans, and wheat. So we had 5 markets out of 6 discussed. Now we're looking at the softs, okay, and these are like foods. And the first one we're looking at is sugar. You can see how the deflationary issues came in, and price of sugar was dropping all through the first half of the year. No real factor of bullishness at all. Whenever there was bearishness in the dollar, the sugar market just went lower in sympathy with it. So there was nearly no big strong buys in this commodity, but it did have a nice decline in the movement with the dollar index. As a sell back in January and a sell in March, both they were really good timing points for a bearish idea for sugar. So for buys, there is none for sugar, but it did have a nice move going lower. The next one in the softs is cocoa. Cocoa had a really nice move lower at the February-March time period. The next sell-off was the last week or so, middle of March going into April, and that was a little bit ahead of the sell-off we saw on the dollar index. So cocoa was really all over the place a little bit, but it's been in a downtrend anyway. So anytime that this market would have created an opportunity to go short, that would have been a better play, but no mega trade here either. Coffee, deflationary issue as well for this commodity. It's moved lower in sympathy with the lower dollar, and just about every timing point for the dollar, you can see that replicated in the coffee market as well. So while it had a nice move from its highs at the beginning of the year around the 160 level, trading down to 115, 45 cents times $375 per handle. That's the move that we saw there. Now, one way you can do this is when the dollar index is moving lower and commodity prices are going to be moving lower because we're in kind of like a deflationary issue, or deflationary condition rather. The commodity that's failing to make a higher high while the dollar index is rallying up, but overall in a bearish market. Like we look at the dollar index from February to March, it trades higher on the dollar. February to March in the coffee market, we can see that there's a lower high formed there. So you can use the market to time it and go short commodity based on the strength in short-term nature on the dollar index, because if we're looking for lower prices on the dollar index, that rally up, we should see a little bit of movement higher up in the coffee market, but it was failing to do that, and that's underlying weakness. So the benchmark here with the dollar index moving higher, we don't see that in higher prices in coffee in the February month, and ultimately it sold off and kept going lower. Orange juice, very similar. We have the March-April highs, and we have February, last week of February going into March. We see the rally in the orange juice market, very similar to what we see in orange juice, but ultimately the dollar going lower pulled orange juice prices lower because of deflationary conditions. No real mega trade here either for orange juice. And again, orange juice is one of those ones I include just because if there's a frost in Florida, or if there's something going on with the citrus markets, it'll cause the orange juice market to go vertical, like lock limit up, and really, really fun market to be in if you're long. But apart from that, it can be a really sleeper. Okay, the fiber in the softs is cotton. And this was a market that's been going relatively nowhere. It's been back and forth, back and forth. We had a slight little bullishness in the May month with the sell-off in the dollar index, but it quickly gave that up and rejected it and moved about 14 handles lower. And each one of those handles is $500 per contract, but really nothing here to speak of for cotton. So this was a sleeper as well, nothing going on. So we've completed the whole agricultural scan, and out of those agricultural markets we had wheat, soybeans, both live and feeder, and lean hogs. We had nothing out of the foods, and we had nothing from cotton. So the two sectors out of the agriculturals that big money was pouring into was the meats, and just most recently here in the last month or so, the grain market. So the strongest sector for the first half of the year, if I were to ask you, which one would it logically be in the agriculturals? The meats. Okay, so lean hogs, cattle, and live cattle were all the big money was pouring into for commodities, and they were the long leadership issues. Later on in the year, the last month or so, the grain complex created a buying scenario, and then we saw big moves there. We're going to be looking at the financials next. So now we're looking at gold against the dollar index. And we can see generally when the dollar index is going lower, that's going to be bullish for gold. So if you look at the dollar index, where periods of short-term highs were forming and then a decline ensued after that, you can see that there's pretty much a nice correlation there where the dollar index does go lower in May. May we saw a little bit of a rally in gold. In the month of March, we saw the dollar index slide. In the month of March, we saw gold rally. We saw the dollar index sell off in the beginning of the year in January, and we saw the gold market rally as a result. What is concerning for me is that we didn't see a sustained uptrend in gold, okay, where we see a very nice lower low, lower high, stair-stepping lower on the dollar index. We don't see that so much on the gold market, which is, in my opinion, showing, while there is opportunities for it to rally against the decline in the dollar, I don't see it showing real leadership issues, which is the reason why we didn't see a big move in gold. We saw short-term swings and short-term buying opportunities for gold, but it didn't have that sustained type of a move. And if you look at every time that the gold market did rally, it did give us a decline in open interest, which is obviously short-term short covering for the commercial traders. So if they're going to be covering their shorts with a reduction in open interest, that means they're expecting higher prices. At the same time, the dollar index was giving us sell scenarios. The gold market made rally. So while they did give us buying opportunities, I would not classify this as mega trade conditions. And let me say this before I get into silver. It's not mega trade conditions because after the fact, each one of those buying opportunities could have led to a mega trade where it moved, a much more sustained pace higher, but it didn't do that. It just gave us short-term price moves. Now, while we wouldn't argue with that if we were buying it, it's just the classification for a mega trade would be a much more dynamic, aggressive, one direction, big blast off type move, and we didn't see that in gold. And we didn't see it at all in silver either. In fact, the opportunities for dollar index going lower in March, we saw that same thing occur in opposite terms for a rally for silver. But apart from that, it was a real unorganized market structure for silver. We did get a rally with the decline on the dollar index in May, with a rally with silver, but again, it's having pressure where it's being pulled down from a deflationary standpoint. So while silver did have buying opportunities with the decline in the beginning of the year, in January to the last week of February going into March, the structure of silver diminished, and we didn't have a real bullish structure to support a mega trade opportunity there. So while there was buying opportunities, again, not in the capacity of a mega trade. Copper here, very similar. It was lacking structure, didn't have bullish market structure there. We did get some sympathy rally in the beginning of the year with the lower dollar, with the higher prices of copper, but eventually it was pulled lower with deflationary pressures as well. In May, that was the only time we saw correlation with the sell-off in the dollar with a rally in copper prices. Now we're in the energy sector. You see in the April time period when the dollar index sold off, that was exactly timed with the sell-off in the crude oil market. Then we had another sell-off in May. Crude oil was a little bit late. It was the third week of May, while the second week of May, we saw the dollar index make its high and sold off. So again, deflationary conditions pulling oil lower with the lower dollar. And heating oil, very similar. The sell-off in April and in May, we saw that in heating oil as well. So everything being reduced in price from a deflationary standpoint. No mega trades in heating oil, and natural gas as well lacked a market structure. And admittedly, I have zero experience trading natural gas. I include it because some of you may become the next natural gas trader. I don't know. But I include it here for completeness sakes, just like I do with the orange juice market for the softs. The sell-off in May and in April with the dollar index was seen with lower prices in natural gas. Going through all of the agricultural and now the financial instruments for the commodity markets, we came away with just two sectors where the markets saw most of the big moves buying with a lower dollar. Those being the meats and the grain market. So soybeans and wheat were the grains for the buys for a mega trade just in the last month or so. And I only say mega trade in the sense that it gave us more than 3,000, $3,000 to $5,000 per contract or more. I think is a classification for a mega trade where there's a nice big movement permitted in price, and ideally I'd like to see like $5,000 to $10,000 moves in the commodity. And generally it takes a lot of movement to do those types of things, and every year you'll get some sector that will move in as a leadership sector. This year it was the meats, live and feeder cattle, and lean hogs. So for whatever reason, the meat eaters are in a ravenous hunt for more protein. So that sector has been bullish this year. The grain market came under buying pressure in the last month or so, and then everything else has been pulled lower under deflationary conditions. Lower dollar and prices have been pulled lower as a result. We did not see that in the grains or the meats, and by them bucking that trend and those sectors also creating premiums, that gives us the context for the market to want to explode up and rally higher. And that's a mega trade. That's what you want. You want to see dynamic against the grain type price action and conditions that would lend well for explosive movement. Out of all the sectors that we looked at for the commodity market, there's only two that did it. And that's like the hallmark signature. Not every commodity is going to move the same way each year. Every year, there's going to be a new sector or a new commodity group that has some measure of leadership. And we're looking for that. And when that occurs, our focus is there. And when you participate in those commodities in a paper trade, you'll see that those moves can last for a long time. And they're not typical like a bull market. They are like one-sided, parabolic, and they just keep going, going, going. If you look at the lean hogs chart again, go back and watch that portion of this video, and you'll see the chart looks unbelievable. It's like explosive from April lows, and then just keeps on going up, and it's violent about how it goes up. It's not just trending up and down with retracements. It's going up, going sideways for a minute or two, and then goes up again hard. That's a commercial bull market. That's a different type of bull market. And you only see those types of events in commodities that have markets that sell with a nearby contract with a higher price than that of the distant months out, where that should be the normalcy. You should see those later months that have yet to be traded to in terms of the calendar date. They should be more in price because it's more cost associated with that time gap between today and when that contract delivery month would be coming to the market to be delivered. If it's ever reversed and the nearby months are selling for more, that is the clearest indication from a fundamental standpoint that commodity is very, very short supply and high demand. Otherwise, it would never be priced that way. So hopefully this has helped you in terms of what mega trades look like, and we used the first half of this year. We still have the second half of this year to do, and when we get into the fall months, we'll be able to ferret out those hopefully before the end of the year and be a participant of that with a paper trade. Until I see you tomorrow at 8:15 a.m., I wish you good luck and good trading.